Thank you all for being here. This motion asks a simple question. When a protocol earns revenue, how should that value accrue to the token holders? Token buybacks are one answer. The protocol takes its earnings, goes to the open market, and buys its own token. Supporters call this value accrual. But in practice, it's an opaque, often mistimed, and structurally broken mechanism that enriches insiders, perverts the incentives of protocol developers and founders, and inhibits institutional adoption and trust in digital assets. Let me define terms precisely. We're talking about buybacks as they exist today, as practiced by protocols like Hyperliquid, Pump.Fun, and Jupiter. Programmatic or discretionary purchases of native tokens using protocol revenue. The alternative we propose is simple. Distribute that revenue directly to stakers as dividends. That's how Solana works today. Token buybacks fail in three ways. First, they're opaque. When a protocol distributes staking rewards, every holder receives value in the same proportion, visible on chain, with no discretion from anybody. When a protocol conducts buybacks, a small team decides when to buy, how much to buy, and through what channels with no oversight whatsoever. It's an invitation to abuse. Teams may front-run their own announcements or buybacks. They can time buybacks around liquidation cascades, hunt liquidation levels, time them around their own team unlocks or exchange listings. They can extract value through spreads and revenue shares with affiliated market makers. In traditional finance, they spent decades building the rules and infrastructure to prevent exactly this behavior through things like blackout periods, disclosure requirements, safe harbors. But crypto buybacks have none of those things. So we've recreated the conditions for insider trading and called it innovation. The second reason token buybacks fail is pro-cyclicality. Protocol revenue is pro-cyclical. Fees are highest when speculation is highest, when token prices peak. This means that buyback programs mechanically purchase tokens at the worst possible times. They buy high, they go quiet when prices crash and revenue crashes with it, and that's the time when buying would actually make sense. That's not a theoretical concern. You can go look at any protocol's buyback history against its token price chart and see the results for yourself. The third reason that buybacks fail is perverse incentives. Buybacks require trust from investors that the protocol developers will actually follow through, trust that the team will keep doing the buybacks into the future, trust that revenue won't get diverted to private jets and other things that the protocol developers might want to pay for with protocol funds, and trust that when the numbers get large enough, nobody will defect. Crypto has no mechanism to enforce that trust, so what happens? Teams feel pressure to start buybacks too early, before they've built sustainable businesses, cannibalizing growth capital to satisfy impatient holders. And every holder or investor knows that the team could stop at any time tomorrow, or quietly redirect funds, or cash out through a dozen opaque channels. The promise of future buybacks is worth exactly as much as your faith in those founders. Staking requires no such faith. It's code, it executes or it doesn't. The value flows automatically to token holders. Let me leave you with this. Buybacks sound like shareholder returns. They borrow the language of corporate finance to provide a veneer of legitimacy. But they lack every safeguard that makes buybacks tolerable in traditional markets. There's no disclosure, no oversight, no accountability. This house believes token buybacks are a net negative value accrual mechanism. We are right. Thank you.
Thank you so much, Max. I can see that we are already winning. So, look, I just wanted to maybe give you a couple of numbers to start with. So just this year, 2015, 28 projects did meaningful buybacks. Only 28 projects of thousands of tokens that we have. So it's a really small part of a value distribution mechanism, how we call it with Bartosz. And if you ask me how much, roughly $100 million are bought back every month. The only exception was in September when Layer 0 did a one-off buyback of $150 million, maybe because of the investor pressure. And so, let's take $100 million a month times 12 months, 1.2 billion. We add Layer 0, it's like $1.4 billion that we are using as an industry every year to buy back the tokens from circulation. But remove Bitcoin from market cap, it's roughly only 10 basis points. It's really, really small. Now, the motion is saying this house believes token buybacks are net negative. I think there are bad token buybacks and there are good token buybacks. And this is why we think this motion is false. And good token buybacks are those which are using real revenue after product market fit is clear to buy back tokens from circulation. Real revenue. Bad token buybacks are those which are doing buybacks in an opaque way, like Max mentioned. I agree with you. I'm against, buybacks which come, one-off in September, like Layer 0 did. I also think buybacks are wrong when they are just done from the treasury. I think buybacks should be done from revenue model. And so that's how I think token buybacks, it's not a value creation mechanism. Token buybacks is actually a value distribution mechanism. And how else would you distribute value in our industry? Yes, you could do, like Max mentioned, staking and then emissions, but what happens? You will basically give your tokens to snipers and Sybil attackers and then traders who will dump it. Like, is this really? I think it penalizes the long-term holders. So I think good token buybacks are here to stay. I spoke earlier with Chao from Jupiter. I think Jupiter is a good example, using 50% of their revenue to buy back tokens. It costs them roughly...
Point of information?
Yeah.
Why do they only use 50% of their revenue to buy back tokens?
Because they are using the other 50% for M&A and further growth of the business.
But why not just use all of it for growth of the business? They're an early stage company. They're finding early signs of product market fit. Why don't they go ahead and go all in on growth? Wouldn't that be best for investors and the team?
You mean remove the buybacks completely?
For now, and then later build a business that's even bigger and do more buybacks in the future.
Yeah. Well, I think it anchors the floor to their valuation. So if they're buying $100 million per year and their market cap is 1.5 billion, that's roughly, 15x? I think 15x, I think it's an excellent multiple. Like Hyperliquid is buying back $700 million per year, trades at like 30 billion. It's like more than 30. It's like a 34 multiple. So
Point of information?
Will you let me speak, guys? I'm just kidding.
I think Hyperliquid's an interesting example. They do a lot of buybacks, but their market share is decreased over subsequent months. And so do you think that the market is really valuing buybacks versus the growth of other protocols and competitors?
Yeah. Well, I think those are two different things. Yeah. So you are doing buybacks to distribute value to the token holders. But at the same time, of course, you have to grow the business. That's why I like Jupyter model, 50% growth and M&A, and 50% to distribute value to your long-term holders.
All right. So I think Viktor laid out an interesting framing of good versus bad token buybacks. I think we can all agree that bad token buybacks are net negative. And the further point that we have to convince all of you on is that there are no good token buybacks. It's a false premise. And the reason to add to what Max was saying is that buybacks are a short-term incentive mechanism when projects and companies should be thinking long-term. Allocating that capital for growth, whether it's at an early stage or later stage, is far more value accretive to the protocol than simply spending it on token buybacks. And the other important part of why these buybacks are net negative is that crypto is incredibly cyclical. And so what that means is this revenue is very volatile. And what happens when buybacks are conducted, whether in a programmatic way, you end up top blasting the chart all the way up, and being very inefficient about the price that you're buying your tokens back at. Even discretionary buybacks end up really reducing the amount of capital that you have to weather a more cyclical cycle. And I think the thing that this also gets at is buybacks are really just symptomatic of a larger problem. And that problem is that equity versus token projects are currently divided. And so when you have a company like Pump, for example, the question is, why are they doing 100% buyback? It's because there's not investor confidence that the value is going to accrue to the token versus the equity. And so buybacks have become this perverse incentive to have to convince investors and other stakeholders that revenue is actually going to accrue to the token rather than the equity. And so the solution here is to forego buybacks and restructure projects, because buybacks end up being net negative versus having a single asset accrual model. The other thing that we can look towards is the public markets, where stock buybacks obviously happen, but the reason they happen and have increased over the past decade is because there's a perverse incentive in how they're valued. And so we might look at the public markets and say, well, they increase buybacks in the public market, so we should be doing it in crypto. We should borrow from best practices. But in reality, a lot of stock buybacks in equities happen because of stock-based compensation for C-suite level executives. And so that further pushes companies to focus on buying back stock versus actually growing the business, reinvesting in research and development, talent, and other things that are more net value accrutive to the actual company itself. And so we can conclude here that just because the public markets lay one example, that is not actually the quite right reasons for why we should think about buybacks of projects. And
just one question on that topic. But in our industry, teams also hold tokens. So if buybacks are effective, that holds the price of a token, so it's beneficiary to them as well.
I think artificially trying to optimize for the price of your token because you think that people might sell is exactly the wrong framing. It should be, how do we reinvest that capital to prove to the market that we have a growth story and that there's going to be upwards trajectory rather than downwards trajectory, which results in selling. And so as we look towards the variety of projects in the market, I think you can clearly see that buybacks, while common in some high-profile projects, don't actually lead to the best value accrual in a long-term basis. Whether it's hype, whether it's jupe, or a variety of other assets that have used this as a crutch rather than to double down and invest in growth. So thank you.
So it's interesting that we constantly have this comparison between equity markets and crypto. And the argument effectively here, equity markets are more transparent, so they have more options to do things. I fully disagree with that. In crypto, we have more transparency. We know how people are doing the buybacks on chain. We know how much they are buying, to the degree that the teams are worried that people will front-run their buybacks. In equities, if you look at what you are doing normally as a company, you can submit to SEC, for example, your filing, and you say, OK, I'm going to do the buyback, maybe $1 billion worth of buyback over the next year. And then you can sit on it, and you don't need to do anything. You don't need to do a buyback. You have an option to do a buyback. If someone like that did something like that in crypto, there would be a massive outrage. When Pump is announcing, hey, I'm going to do a buyback of this much, 50% of my revenue, every day, every month, whatever. Everyone is tracking it and they see it. We have more transparency. The other argument that was made that not doing buybacks and doing staking is more efficient. It's similar to dividends. Dividends and buybacks are very similar in equities. Staking, on the other hand, in crypto is very different. To a degree where I believe if Hyperliquid, Jupiter, or Pump try to do dividends, they would be effectively taxable income. What people are doing right now with their buybacks allows everyone to accumulate the gains without taxes, which gives you the higher shareholder value or token holder value. You want to minimize your taxes. But ultimately, it's all about the growth. I think both sides agree that if the protocol is growing naturally, the buybacks are a decision of a team because they believe that this is the highest value accrual to the token holders.
Point of order. Would you agree that when a team is deciding to do buybacks versus reinvest that for growth in the company, that they're effectively saying, for $1, I can't produce more value in my company, and therefore I should just return it to investors?
Yes and no. The main thing that I would disagree with is I cannot produce more value. It's not about can I produce more value or not. It's about marginal efficiency of producing that value. The team is saying we could spend it on growth, but marginally it might be better to do a buyback.
So when you say that the protocol developers have the choice between whether to do a buyback or whether not to do a buyback, I think the empirical facts of the case are not that, especially in the case of Pump. They were doing a 25% buyback. They were getting killed in the price charts. Everybody was flaming them on Twitter. And Elon basically had to go to 100% buyback just to assuage concerns that they weren't going to return that money eventually. He thought initially that the best thing to do was to spend 75% of the revenue of the protocol on growth. And if you talk to him, he's a very ambitious person. But what the market told him is, we don't believe you that you're going to grow this business. And then in particular, we don't believe that when you do grow it, you're going to give that money to us. In traditional finance, there are shareholder oversights, there are laws that require that. That contract exists because there are laws in place and you can make a commitment like that. There's no such thing in crypto.
Which specific laws are forcing companies to do a buyback in equities?
The 1933 Securities Act governs issuance of securities in the United States, and it requires mandatory disclosures, transparency, and corporate governance that allows people who are building companies to commit credibly to something like Uber, which is not make any revenue for years and then grow and grow and grow and then eventually turn on the money.
There's no law that...
If I may on Pump, they also have $2 billion treasury. $2 billion at 5%, that's like $100 million, which they can use to grow the project and fund their people.
But why did they start out at 25% and now they're at 100%?
To test where the market is, ultimately. It's a conversation with the market.
But the market knows that Apple has $50 billion on its balance sheet. How much does Pump have? The market doesn't know.
I mean,
it's not transparent. $2 billion. No.
Yeah.
Well, they've spent some.
Yeah.
Right? It's not public how much they actually have.
I mean, it's public how much money they raised and how much money they made.
Yeah, but you don't know what they spend. And so my point is there's more public disclosures which give investors more confidence in the public markets versus today in crypto.
Shall we move to closing statements?
Go ahead.
Let's do it.
So I think we both agree that this is all about optimizing spending on growth. Crypto is a new industry. We're just starting to find product market fit. And so it's really important that the money that is made keeps getting reinvested into the system to grow the pie, to attract new talent. There are companies that can do that. For example, Axiom, one of the largest companies on Solana, one of the fastest YC companies to $100 million of ARR in history, they're able to spend to attract new talent because they don't have a token. Meanwhile, other companies are forced to compensate in token, and then they're forced to use all the money that they earn to appease investors. That's not me saying that. That's the other side admitting that in order to assuage investors, in order to feel out the market, they started at 25%, which is where they thought was optimal on the growth trade-off. And then they ended up going to 100% because the market in the price chart was telling them, no, you're wrong. We want to see that commitment from you. Buybacks work in traditional markets because of the structure that is there that allows companies to commit to deferring revenue into the future and deferring value accrual. They don't work in crypto because there is not that same trust. In fact, crypto is trustless by design.
Yeah, okay. So thank you, guys. I would say, look, the statement is wrong. Good buybacks are here to stay. And you mentioned that buybacks are opaque. We agree with that. Buybacks, good buybacks, need to be transparent. You mentioned they are done at worst possible time. We agree with that. Good buybacks need to be done, transparently and periodically on a monthly basis and on a blockchain. And you are also mentioning that it creates a perverse incentive. I would say I don't see in crypto any other better value distribution mechanism because staking or airdrops are basically just compensating snipers and civil attackers. You're also mentioning that projects are forced by the investors to do 100% buybacks. We don't think this is true. Basically, the additional value which the project doesn't need for growth of M&A distributes to token holders by doing buybacks. Those are good buybacks. Good buybacks are also those which are transparent, so they are on-chain. They are also helping because they are tax efficient, and yes, there need to be more public disclosures about the treasuries and about the buybacks.
Is that it?
I think so. Thank you, everyone.
Thank you, guys.
Thank you.
So we won? We won.